Be informed inheritance tax planning. Inheritance tax, or IHT, and the associated IHT planning has become increasingly important as the upward trend in the value of residential property and other securities continues. In many cases, the largest beneficiary of an estate is HM Treasury. There are reliefs available which can mitigate the impact of inheritance tax. For example, investments in unlisted or alternative investment market or AIM-listed trading companies which have been owned for at least 2 years may qualify for 100% relief against IHT. This is because these companies qualify as relevant business property, which in turn qualifies for business relief, or BR, referred to as business property relief, or BPR. Business relief only applies when someone dies, and it is the estate that claims the relief. The key point is that when an investor dies, they must own and have owned relevant business property for at least 2 out of the preceding 5 years before death. Replacement property relief allows for gaps in the ownership. Generally, all EIS and SEIS investments should qualify as relevant business property, as will some of the less risky investments which don't qualify for EIS or SEIS relief, such as renewable energy, but still qualify for business relief. Investments in AIM-listed companies via an ISA can qualify too. You don't need to subscribe for new issues of shares to qualify for business relief. You can simply buy shares off an existing shareholder. This means that investment managers who run business relief portfolios are able to create a liquidity facility by matching new investors with redemptions, or by the underlying companies themselves buying the shares off investors. It's important to understand that this liquidity is not guaranteed. Another means of maintaining liquidity in the portfolios is to invest in AIM-listed companies. Liquidity on the AIM market does vary from company to company and can change very quickly. There are benefits to investing through a diversified portfolio rather than making a single investment. The first point is that these investments are not without risks, as liquidity can change unexpectedly and trading companies do fail from time to time. Building a diversified portfolio reduces this risk. A further benefit of a diversified approach is that apart from the investment risk considerations, there is less risk that all of your client's investments will be sold to cash just before your client dies. In other words, diversification also reduces tax risk. If you are going to use illiquid investments to manage inheritance tax, you need to consider the needs of the beneficiaries as well as those of the client. It can take a number of years to liquidate any portfolio of business relief qualifying investments. Clients with capital gains or significant income tax liabilities should consider EIS and SEIS in the first instance. However, the beneficiaries' needs should also be considered. Business relief, also referred to as BPR investments, usually carry better liquidity and are often simpler to understand. To summarize, inheritance tax can severely deplete wealth, and using relevant business property to mitigate its effect can be a powerful planning tool.